Hello everyone, we are back with a new day and a new video. In this lecture, we will discuss International Standard on Auditing 570, which deals with going concern. This topic is important for both auditors and users of financial statements because it relates to an entity's ability to continue operating. Let's begin with the definition and overview of ISA 570. The going concern concept assumes that an entity will continue its operations for the foreseeable future and does not intend nor is required to liquidate or significantly reduce its operations. So ISA 570 provides guidance to auditors on how to evaluate management's use of the going concern basis of accounting when preparing financial statements. In simple terms, this standard helps the auditors assess whether it is appropriate for the financial statements to be prepared on a going concern basis and whether any uncertainties related to going concern need to be highlighted to users. This slide explains why ISA 570 is important. First, going concern is a fundamental assumption underlying financial reporting, meaning financial statements assume the business will continue operating. Second, financial statement users depend on early identification of financial distress to make informed decisions. Third, ISA 570 enhances transparency by requiring clear communication of going concern uncertainties. And finally, the standard ensures consistency in how auditors deal with business survival risks across different audits. So, the objectives of ISA 570 are clearly listed here. First, the auditor aims to obtain sufficient and appropriate audit evidence regarding management's use of the going concern basis of accounting. Second, the auditor must conclude whether a material uncertainty exists related to events or conditions that may cast significant doubt on the entity's ability to continue as a going concern. Third, the auditor must determine the impact of going concern issues on the auditor's report. Finally, the auditor must ensure that appropriate disclosures are made in the financial statements when going concern issues exist. Applicability and coverage. So ISA 570 applies to all audits of financial statements regardless of the size of the entity or the industry it operates in. It includes evaluating management's going concern assessment, identifying events or conditions that raise doubt, and assessing whether disclosures are adequate. However, it does not include business valuation decisions, and the auditor is not responsible for guaranteeing the future survival of the entity. These are a few key terms we need to understand. The going concern assumption, as I told you before, means the entity is expected to continue operating for at least the next 12 months. A material uncertainty refers to conditions that may arise significant doubt about the entity's survival. The foreseeable future is the period covered by management's assessment, and mitigating factors are management's plans to address financial difficulties and reduce going concern risk. What is the management's responsibility? So management has the primary responsibility when it comes to going concern. They must assess the entity's ability to continue operations, use the going concern basis unless liquidation is intended or unavoidable, and make adequate disclosures when uncertainties exist. For example, management may prepare a cash flow forecast for the next 18 months and assess whether upcoming loan repayments can be met. So this assessment forms the starting point for the auditor's work. Auditor's key responsibilities. So the auditor's role is to evaluate management's assessment, not to replace it. So the auditor must obtain sufficient and appropriate audit evidence, conclude whether a material uncertainty exists, and determine the impact on the audit report. It's very important to remember that the auditor does not guarantee the future survival of the entity. The auditor provides reasonable assurance, not certainty. Okay, there are certain events or conditions that can raise doubt about going concern. Financial indicators include recurring losses and negative cash flows. Operating indicators include the loss of key customers or labor problems. Other indicators include legal proceedings or inability of a company to obtain financing. So, for example, imagine a company that has suffered losses for 3 consecutive years and has a bank loan repayable within 6 months with no confirmed source of refinancing. So, this situation clearly raises going concern issues for that company. So, auditor evaluation of management's assessment. The auditor evaluates several aspects of management's assessment. This includes the period covered, the assumptions used in cash flow forecasts, the reliability of underlying data, and sensitivity analysis of key assumptions. For example, an auditor may challenge management's assumption of a 30% increase in sales when historical growth has only been 5%. So this kind of challenge is critical under ISA 570. What could be the management's plans to mitigate going concern issues? When going concern issues exist, management may plan certain corrective actions. These plans may include raising new debt or equity, selling assets, reducing costs, or obtaining support from a parent company or shareholders. The auditor must assess whether these plans are realistic and achievable. For example, if management plans to sell unused land, the auditor will check for potential buyers and review valuation reports. So in this slide, we will see that how in different conditions the auditor reporting changes. So first is if there is no material uncertainty identified by the auditor. So according to the auditor, if going concern basis is appropriate, no material uncertainty exists, then he will give unmodified audit opinion. No separate going concern paragraph is required in this case. For example, if a company has losses but has a legally binding parent company guarantee. Next condition is if material uncertainty exists and the company has done adequate disclosure about it. So if the going concern basis is appropriate, material uncertainty exists and the disclosures are adequate, then he will give unmodified opinion and will include a separate section in his audit report titled as material uncertainty related to going concern, and the notes will clearly explain cash flow problems and dependence on refinancing. In case of inadequate disclosure, he can either give two kind of opinions. If uncertainty is material but it is not pervasive, so he will give a qualified opinion, and if uncertainty is material and pervasive, then there is chance that he will give adverse opinion. So for example, company breached loan covenants but does not disclose this in the notes, so it can qualify for either of the two opinions. And in case the going concern basis is wholly inappropriate, if financial statements are prepared on a going concern basis but liquidation of a company is inevitable, then he will give adverse opinion. That company is already in liquidation but accounts are prepared on going concern basis. Now let's look at a practical example. A retail company has experienced declining sales and negative cash flows over the past 2 years. Issues include repeated operating losses and difficulty meeting loan repayments. The auditor would review cash flow forecasts, assess management's plans to improve profitability, and evaluate the availability of financing. So this links directly to ISA 570's requirement to identify adverse financial conditions affecting continuity. In another example, a service-based company relies heavily on one major client who has announced contract termination. So the issues here include a significant expected loss of revenue and uncertainty over replacement contracts. So the auditor would assess the impact on future cash flows, review management's diversification plans, and evaluate whether the uncertainty has been properly disclosed in the financial statements. How it is linked to ISA 570, that the auditor will consider external events that have created uncertainty about the operations. Okay, there are several common risk areas in going concern assessments. These include overlooking early warning signs, placing excessive reliance on management explanations they are on part of auditor, weak documentation, and inadequate evaluation of future cash flow projections. Weak documentation can in turn lead to inappropriate audit reporting and reduced credibility of financial statements. So, when assessing going concern, auditors should focus on financial trends, cash flow adequacy, debt maturity profiles, and management's ability to implement mitigation plans. Clear documentation and professional skepticism are essential throughout the process for the auditor. So, to quickly recap, ISA 570 focuses on whether an entity can continue its operations in the foreseeable future. Management is responsible for assessing going concern, and the auditor's role is to evaluate that assessment and the supporting evidence with professional skepticism. Identifying any material uncertainty is critical as it directly affects disclosures and the auditor's reporting decisions. Ultimately, clear disclosure and appropriate reporting enhance the reliability and usefulness of financial statements for users. And with that, we wrap up ISA 570 ongoing concern. If this breakdown helped you understand the topic better, feel free to like the video and subscribe for more accounting and auditing concepts explained simply. Bye bye.